You're watching a replay from the 49th Annual Gabelli Automotive Symposium, recorded live via Zoom in Las Vegas. This presentation is shared as originally broadcast. Minor technical interruptions may be present due to the live recording format. Thank you for tuning in.
It's my pleasure to introduce Sonic Automotive, who is a leading automotive retailer operating about 133 new vehicle franchises and from about 141 stores across the U.S. Apart from that, they also sell used vehicles to their Echo Park segment, and then they've also entered into the power sports market, which they sell new and used motorcycles, personal watercrafts, all-terrain vehicles. They have 22 Class A shares, 12 million Class B shares, closed around, price around $62, so about a $2 billion market cap, about $1.5 billion debt, and about $100 million net cash. So it's my pleasure to introduce CFO Heath Byrd and Senior Vice President of Investor Relations, Danny Wieland. All right, so just to get started, if you guys don't mind, just give a quick about 5-minute overview of the company, just for people in the audience who might not be familiar with the story.
Sure. Okay, so Sonic Automotive is basically three different segments. The larger segment is the franchise business, where we have anything from Porsche, Audi, BMW, Mercedes, Honda imports, as well as domestic across country. The second segment is a used car only segment. It's called Echo Park, very similar to a CarMax Carvana model. And then, as we mentioned in the introduction, we have a third segment, which is the power sports segment. We got into that one recently. We see opportunities in that sector from a standpoint of very, very low multiples relative to the other two segments. So acquisitions have a higher return. And we also see it as it looks a lot like 1990 automotive retail. And we've done a good job of that on the franchise side. And there's a lot of opportunities, same opportunities in that segment around consolidation. There's really no sophistication in marketing, et cetera, and opportunity in used and service. So it's our smaller segment, but a good opportunity for growth in that one. So three different segments focusing on new franchise business. Echo Park is a used business, and then the power sports business.
Perfect. Thank you for that. So just given some of the new developments in the finance and subprime markets, can you just describe to us the current health of the F&I your loan book in light of broader tightening in subprime credit?
Yeah, I think we're hearing about more delinquencies, especially in the subprime market. All of our sectors, our FICO in the franchise is around 710, and our average FICO in Echo Park is very equivalent, but we are seeing a higher percentage in the subprime. That's the fastest growing segment. So there's definitely concern. I think there's tightening. We just talked about now we're at Echo Park, we're about 55% of approval rates in finance. But we haven't seen anything, right at the operational level that's been detrimental to this point. But it absolutely is a concern that we're watching and monitoring.
Perfect. Thank you. So, yeah, with some of the recent bankruptcies, what differences in underwriting or collateral structure gives you confidence in the portfolio?
Again, we do indirect lending. We don't have our own FinCo, and so there's more risk, obviously, on our third-party lenders. But it is tightening, but it hasn't been something that's been detrimental materially to our business to date.
And have you made any changes to credit standards or approval rates on your end?
From a underwriting perspective?
Yeah.
No, again, the underwriting risk is with the third-party lender, and so there's been no changes from our offering of products, et cetera.
Gotcha. Just moving on to some of the newer used environment on the franchise business. How would you describe the current retail environment for new vehicles, especially with the resilience of the customer in light of the 50,000 plus price?
If you look at it overall, the way that a lot of people look at it is a SAR, and I think projections are still in the 15.8 to 16.2, which is more than last year, a little bit more than last year. And so that's a very healthy market for us. That's one of the highest and something that we can operate very well in. If you look at things that are driving that, if you look at inventory, everybody's concerned about inventory with the new vehicles. It's really normalized. I think we're at an 89-day supply nationally, if you look across, which is really similar to pre-COVID. So, but it's different by brand. If you look at the Hondas, Toyota, Lexus, very tight day supply. They've been very disciplined how they've come back. And so that allows them to maintain their prices and margin, which is very good for us. And then you got the other end of the spectrum, which is the Chrysler, Mercedes, Audi, that are a little bit higher. And so we expect those individual brands will be required to bring incentives to really push metal in the fourth quarter. So inventory wise, it's pretty much in good shape. We talked about on the earnings call some concern with the luxury brand. And what's driving that is if you look at Mercedes, BMW, and Audi, the activity did slow down in October, and we saw that for the full year, we're still up on each of those brands year over year, but it really got slow in October. And so we were really trying to send a message to the manufacturers, you need to get your incentives in place and do it quickly. And so we are seeing that happen. And so I think that that's going to really help the fourth quarter sales. But that was one of the issues with there's really more inventory than we needed based on the activity, and that those incentives will spur that, we believe.
And to add one more point to that, obviously in the third quarter, there was a big push for electric vehicle penetration, ended up near 12% of our mix, about 10.5% of the industry. They've been running in the 6.5 to 7%. That's heavily concentrated in those luxury brands, those German luxury brands in particular, especially for Sonic's portfolio, which is more than 50% of our revenue comes from those luxury brands. So there's also a little bit of cadence or pacing distortion. But as we move into the fourth quarter, typically BMW, Mercedes, Lexus, Audi all pushed to have a strong year-end closeout. And we were really fortunate to right size our electric vehicle inventory mix down to about 4% of our inventory at the end of the third quarter. It had historically been running in the 10 to 15% mix, which is what puts pressure on GPU. So there's some opportunity in those brands in particular now that we've removed that electric vehicle headwind.
And I think from an overall consumer perspective, I think the incentives are going to help move vehicles. The concern is that you do see slower spending by the consumer. You do see consumer sentiment was down in October. And I think it's the things that we all see. It's the concerns about the shutdown, overall economic conditions, the impact of tariffs. And the one thing that we're going to find out if it's true, I do believe there was a lot of pull forward in the second and third quarter. The second quarter because people were trying to buy before the tariffs, and then the third quarter because of the EV tax credit being eliminated. And so there is a theory that a lot of the demand that you would expect in the last half has been pulled forward. We're hoping that the incentives are going to override that and continue to have the quarters that we expect in the fourth.
Heath, I put up a number beforehand with a $50,000 average transaction price. And even though we've seen incentives rise, you still have a consumer contending with higher interest rates, and compared to 2 years ago, a used vehicle price that's declined. So, maybe talk about vehicle affordability and whether you think we're pushing any of the real boundaries of what, at least on the new side. And again, you're dealing with a consumer that's a higher FICO score,
Right.
that a consumer can actually afford.
I think it's a real concern, to be quite honest. I mean, now your average monthly payment, I think on new is $750 a month. Actual rates for automotive went up in October. I would assume at some point, if the Fed keeps continuing to bring down rates, that's going to flow through to the buyer on the interest rates of automotive. But I think it is a concern, and it even dwindles down into the affordability of used vehicles as well. But at the price we are now, again, materially right now, we're not seeing that. We still have a really strong consumer. We are 50% luxury, so it's a different segment overall. But I do think that we're going to get to a point that, manufacturers, I think there's 2 cars made today that are under 30, 2 or 3 in total. And so I do think there's going to be an opportunity for some manufacturer to hit that group because affordability is becoming an issue from my perspective.
Do you see that at all in like areas like C-Class or 3 Series or maybe some of the lower tiered Mercedes or BMW vehicles where maybe you're seeing softness relative to maybe some of the more expensive SUVs that they're selling?
Yeah, it's a good question. From a brand perspective, I wouldn't have the data to tell you exactly if it's if it's softer in that area, which would indicate that it is only the higher end consumer and the higher vehicle models that are actually, I guess, hiding some of the softness that would be in those lower models. It would make sense to me, but I'd have to look at that specific data to tell you.
So you mentioned your gross profit for units earlier. Can you just talk about what's happening between those and the new and used segment in the businesses, and then where you think kind of sustainable margins will look like in the future?
Yeah, I think we ended up at, you said new vehicle margin, right? Yeah.
Yeah.
Yeah, and so I think we ended up at 3,000 up, was it?
Down from 3,050 year over year.
Exactly. And so we've said for a long time, we believe that Q4 and for a full year of 2025 will end up around 3,100 to 3,200. We've said for way back that we think when it normalizes, it's going to be more higher than pre-COVID and in the $2,500 to $3,000 range. It's going to be interesting to see what happens. We do think that as inventories normalize, that the margins are going to get into that range, but it's going to be interesting to see what happens with this chip issue and with China and the things that are happening there. Honda just reported that they're slowing their production of certain models because of that issue. And if it continues, it could actually affect more manufacturers, obviously. And then we're right back into the case where new vehicles are scarce and margins, they went up to what, 6,522, I believe. I don't think it's going to be like that, but it is interesting that we all keep thinking it's going to normalize and be back the way it was, and something happens every single time.
And I think to that point, if you went backwards a year and said that we were going to be down 2% year over year in new vehicle GPU, people would have thought that we were crazy looking at that outlook. And so there's been far more stability in new GPUs relative to those who are newer to the story. Relative to 2019 levels, we generally ran between $2,000 and $2,100 a unit in GPU. Again, targeting 3,100 to 3,200 for full year and fourth quarter this year. Even if we fall into the 2,500 to 3,000 range, you're seeing significant sustained upside. And if you think about normalization of GPU from a margin perspective, not a dollar perspective, you're actually pretty close on either an ATP or an MSRP basis to where you were pre-pandemic. And obviously the incentive dollars that are still relatively lower as a percent of ATPs, can provide some opportunity to help balance out the supply demand mismatch with whatever slowdown in affordability challenges from affordability there may be.
And that's, it gets back to the affordability, because what you're seeing is the mix of vehicles. And so they're producing the higher margin vehicles, the more expensive SUVs and trucks is a bigger percentage of what we're selling. Therefore, that margin is remaining.
And on a similar, following on the used car GPU portion of that question, we saw similar trends as used car pricing went up. You saw a little bit of expansion from used GPU. We went from a $1,300 a unit range up into the $1,600, $1,700 range at peak. Still running around $1,500. Expect that to come down again due to some scarcity in supply. This is the tightest year for off-lease maturities. So in 2026 through 2029, off-lease maturities should begin to rebuild back toward 2019 pre-pandemic levels. It'll be a slow build, but it should be. We've seen lesser headwinds in used supply in recent quarters, but we'll actually start to see supply tailwinds here, which should benefit volume. And that's where we make a strategic pricing trade-off on GPU versus sales volume and total gross profit.
Gentlemen, I just got a note, just for the sake of the Zoom, could you move the microphone just a touch closer to you? That'd be closer. That'd be helpful.
Yep.
Just want to ask the audience if there are any questions before moving on towards.
Hey, you guys had made the comment on the call a couple of weeks ago about seeing that luxury trend softening, and I think you were just talking to maybe some of it is mix related. Do you see any actual consumer softness? I mean, is it on a BMW was outperforming Audi because they had a better product line? Are you seeing any shift even for the stronger brands? Is this like an economic indicator?
Not sure if I understand the question, but is there a consumer softness issue?
Is luxury soft because of the brand mix and what's available, or is it soft because of the consumer?
It's a little bit of both. I think the number one, it's the aligning the EV and the ICE vehicles. We had too many, the demand for EV is obviously down. And so getting that aligned is a part of it. But I do think that there is a part of it that there's affordability and consumer softness. And that's the reason we're already seeing now that the incentives are starting to come. BMW has signaled that they're coming. Hyundai just came out with one that's a very small part of our mix, but we're starting to see those come. And really, it wasn't just Sonic. If you look at Q3, Sonic was number one in units new, number one in GP growth for new, and overall growth of all of our peer group on the same store basis. But as we were talking to our peer group and during October, everyone was seeing these big decreases in Mercedes, BMW, Audi. And so I do think it's a combination of both, getting the right inventory, getting the EVs out because there's not a big demand now that the tax credit is gone. And then I think there's also overall economic softness in the consumer.
And one caveat to follow on that, we've seen the fourth quarter obviously is the largest quarter, and December is the largest single month for those luxury brands. We've seen where we've had unexpected softness early in the quarter, and ultimately the quarter ends up as good or better. It's just too soon to tell from where we sat, 3 weeks ago or 3 weeks into the fourth quarter, but it was lighter than anticipated as we came out of 3Q.
Yep.
Oh, Brian.
So one follow-up to that question, with regard to what you're seeing, maybe the softness in the higher end, is there anything geographically that's noticeable? And then my second question, you mentioned the potential pull forward in demand Q2 to Q3. Is that, given the diversity of your business, is that just new, or do you also think you see that dynamic within the pre-owned business?
Actually, our pre-owned business is very strong, so I don't think that it's been strong into the fourth quarter. And so I don't think that we're seeing the same kind of dynamics in the used. And in theory, as people, if there is softening, in theory, you've got individuals that would be buying new that end up buying the used vehicle or fixing their vehicle, which also is beneficial for us. The first part of the question again? I haven't seen anything material. I don't know if you have.
I think the only component there would be from a California exposure. That's about 25% of our business, and the EV penetration historically has been 3.5 times the national average there. So oddly enough, there's a couple of our big California BMW and Mercedes stores who are raising their hands saying they need more electric vehicles, which hasn't been something we thought we would hear for several years. So it's going to be a matter of kind of matching the right inventory with those customers by market. I think as the manufacturers figure out what their go forward production mix looks like.
All right, yeah, so moving along to some of the other segments, can you just talk about the Echo Park segment and how that operating environment has changed over the last few years, and then what you expect the opportunities in the future?
Sure. We started actually Echo Park in 2014, and we actually grew it, and it started being some of our most profitable stores into 2019. Obviously, COVID changed a lot for all the used only providers. The supply chain change has happened, and at one point we had 50 locations. At that point, because there were no lease deals being done, the fact that there were fewer new cars being produced, there really wasn't a big enough inventory in the company or in the country, to optimize our inventory of 50 locations. And so we shut down we now have 14 locations.
18 Echo Park.
Yes.
14 Power Sports.
18 Echo Park, 14 Power Sports, and went from 50 to 18. And that's when you started seeing the profitability come back. We're able to optimize those with the current supply of used vehicles. What you're going to see is this is the trough of lease deals. And so going forward into 26, 27, 28, I think it takes to 28 to get back to pre-COVID. Those return lease deals are a big source of what we are doing. And so we think that's going to be a tailwind going forward. And that's one of the reasons that we've halted expansion and start back again in 2026, because we think there's enough supply to be able to optimize inventory across new stores.
How much, when you look at the landscape, and you're certainly not alone in this, to seeing how Carvana has outgrown the industry, how much of their growth do you think is consumers wanting an online only purchase versus wanting the in-store experience that you provide, that the largest competitor provides, et cetera?
Well, speaking, my own opinion, not the company's, I think that I don't think it has anything to do with the online experience. I think it has more to do with, number one, I think Carvana's biggest asset is their brand. I think that if you're looking for a used car, you're going to go to Carvana and shop that. At Echo Park, we literally are $3,000 to $4,000 cheaper for the relatively same car. And the reason that we don't have that Carvana customer is because of the brand. And so as we grow, we have to create that brand to pull them. I do think that every consumer wants to get through the process online. We still see that the vast majority want to see the used vehicle, especially, and drive that vehicle before they actually commit to it. However, we are pivoting as well, as we're looking at, should we start delivering directly to their homes as well? And so that's still on our roadmap as we continue to expand. But I think the biggest pull is not related to an online purchase, because most all of us can do everything up into the delivery. I think it's the brand name. And in many cases, I think it's because it's a challenged credit individual with Carvana. And they approve 99% of their loans. I won't get into the reasons, but they do. And so I think this is the one location that they can go to. And I think that's a part of it as well.
And to add to that, if you look at CarMax, who's less than 3% national share from a used car volume, Carvana, who's growing quickly, still running about half the quarterly volume. We don't have to compete directly with them. There's plenty of transactions available, but the brand awareness is key to have consumers find us higher in their search funnel. We were targeting a different age, make, mileage, price point on vehicle. Our relative pricing to market is different. So we're strategically differentiating ourselves from those other two larger competitors. But it provides the growth opportunity within Sonic. It's 15% of our revenues today. 85% still comes from the core business that, as Heath said, has been performing at or near the top of the peer group for the last 4 quarters. So the core business allows us to invest in and be disciplined about the growth, but with significant upside potential from Echo Park.
And one of the great opportunities at Echo Park is their brand doesn't just sell cars, it allows them to buy cars. And just like CarMax invented, we'll buy your car. And that's the biggest issue we all have is supply. And so I think that's a big advantage Carvana has, that as we continue to buy more and more off the street rather than going to auction, that gives you a bigger margin opportunity.
So a smaller, but an area you guys see opportunity in the power sports segment. Can you just talk about the rationale about entering into that market, and then kind of just the operating environment today and where you see it's going?
Sure. I mentioned it a little bit at the beginning, but basically when you look at the power sports segment across the country, it looks very similar to the 1990s retail automotive. It's very fragmented. It's very unsophisticated in its operational model and its marketing campaigns, et cetera. And so very similar to what retail automotive looked like when Roger Penske and Bruton Smith and everyone went out and started consolidating those and modernizing those. And so that's one of the main drivers. Secondly, if we're buying if we go out and buy BMW stores, I'm paying 10 times EBIT. If I buy a Ford store, I'm paying 5 maybe. And Toyota actually is probably 10 now, but used to be 7. These stores trade for 3 times EBIT, 3 to 4 times EBIT. So you can actually get in at a lower multiple and a better valuation. So those two things combined are the things that are motivating us. We're still trying to build a foundation of, predictable repeatable, sustainable processes, technologies before we really grow that a lot. And the other concerns are we want to see where Harley Davidson is going to go with their leadership, be sure that we're comfortable with that going forward. And the biggest challenge and the biggest difference between the franchise of automotive and power sports is one is a want to have, the other one's a need to have. And that definitely changes the seasonality of that sector or segment.
Perfect. And then just really quickly on capital allocation plan, can you talk about how you're prioritizing capital allocation between organic investments, shareholder return,
Sure.
acquisitions?
Yeah, I think this year you'll see that the vast majority will be in acquisitions. We did 5 large Jag Land Rover dealership acquisitions recently. But we have been given, our dividend went up, I think, 2 quarters ago. We continue to look at a dividend increase as it is. We want to be paying out about 20 to 25% of earnings in our dividends. So we're very committed to that. And again, the organic growth, I think you're going to see capital allocation start transitioning to that category as we grow Echo Park going forward in 2026.
Perfect. Well, we're coming up to the end of the time. I really appreciate you guys coming to Vegas and presenting here, and hope for the best.
Thank you very much. Appreciate your time.
Thanks for having us.
Heath, Danny, thank you very much.
Brian Sponheimer is a portfolio manager and Edward Nakamura is a research analyst at Gabelli Funds. This webcast is a recording from the 49th Annual Automotive Symposium, which occurred on November 3rd and November 4th, 2025, in Las Vegas, Nevada. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of September 30th, 2025, affiliates of GAMCO Investors Incorporated beneficially own 24.44% of Stratec, 10.09% of Rush Enterprises Class B and less than 1% of Class A, 6.44% of Standard Motor Products, 4.39% of Monroe, 3.96% of Dana, 1.68% of AutoNation, 1.17% of Advance Auto Parts and less than 1% of all companies mentioned. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or of the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800 Gabelli 800 422 3554 914 921 5100 fax 914 921 5118 info@gabelli.com.